Assalamu alaikum friends. In this video we shall see the accounting for current liabilities, and one of the current liability which we are going to discuss in this video is notes payable. So what is notes payables? This is a written formally legally executable document, so it's not an open credit like accounts payable. Accounts payable may exist without any sort of a written uh, document, but just for the sake of trade, we one party can avail the credit, the other party can award the credit, and that credit can be not formally documented. So that's accounts payable, right? But in notes payable, it has to be a formally written document. The second feature is that it usually used in a non-traditional lending transaction. So if you take some loan from a bank or a financial institution, then usually uh, this is not executed through notes payable, right? So if you take a loan from, say, a supplier or from a trading partner, then actually notes payable is a document which is usually used. So it also carries interest. So the interest has to be calculated and recorded on the part of the lender as an income, and on the part of the receiver of the money initially, the debtor as an expense. So it is usually of a short-term nature, and finally it can be issued for varying periods of time. And of course, if the time duration is within next 1 year from the balance sheet date, from the date of the statement of financial position, then that has to be classified in the statement of financial position as a current liability. If the time is more than a year, then it has to be classified as a non-current liability. And if the note is supposed to be paid in installments, then the installments that are due within next 1 year are actually classified as current maturity of the notes payable or current liability, and the remaining amount is actually shown in the non-current liability. But this is usually studied in long-term liabilities, not in the current liabilities uh, chapter. So here is an example. First Human Bank agrees to lend 100 yuans on September 1, 2020 by Young Enterprises, uh, who signs a 100,000 yuans 12% 4-month note maturing on 1st January. So some fields are highlighted. You can see the very important is the date of the transaction, which is September 1. The amount of the loan which is taking place by virtue of notes payable is 100,000 yuans. 12% in the interest rate, 4 months is the maturity period. So even if this maturity is not mentioned, we know that 4 months from September 1, so September 1 to September 30, 1 month, October 1 to October 31st, 2 months, November 1 to November 30th, 3 months, December 1 to December 31st, 4 months. So 4 months completed December 31, so the payment will become on January 1. So payment exactly take place just after completing the 4 months. So when a company issues an interest-bearing note, the amount of asset it receives upon issuance of the note generally equals the note's face value. So the company will receive 100,000 young company who is borrowing. So the accounting entry will become, we debit the cash, increase the cash on the asset side, and increase the liability on the right-hand side of the accounting equation. We credit the notes payable. Now, if our financial statements are prepared on December 31st every year, then we have to record the interest due on December 31st, although we are not going to pay the amount on December 31st because the note will mature on 1st January. But since on December 31 we are closing our books, we are preparing our financial statement, so we need to show the relevant expense. So in order to do this, we have to record the expense, and the expense has to be calculated for 4 months. So it has to be 100,000 into 12%. So interest rate is always mentioned annual. So unless it is mentioned that it's a monthly rate. So 12% multiplied by 4 over 12. So we get the 4,000. So the amount of interest that we have to record as an adjusting entry on December 31 is interest expense debit and interest payable credit, right? So these subtitles are appearing automatically in the PowerPoint. So maybe there is some mistake in those subtitles. So please do follow my words, not the uh, subtitles. Okay, so now on 1st January, we will repay the loan. So when we will repay the notes, so notes payable will be debited because the liability is no longer there. So it has to be uh, wiped off from the books. Interest payable is also being paid. So that's what also liability on the credit side. So we debit it and we credit cash by 104,000. So this was a note actually mentioned in months denomination. Now let's see what if a note is mentioned in days denomination. So the same example, First Union Bank agrees to lend 100,000 on October 1. So now we have changed the date from September 1 to October 1. So one change. And it signs a 100,000 yens note, 12% for 120 days, right? So three requirements. What is the due date of the note? What adjusting entry should be recorded on 31st December? And what entry will be made on the due date? So of course on October 1, the entry, although it is not required, but the entry will be straightforward cash debit and notes payable credit as was there in the last example. Now for the calculation of the due date, right? Uh, in days calculation, count the first day but do not count the replacement repayment day. It means for 120 days calculation, we will count the first day, means the October 1 on which the transaction is taking place, we will count that day. But the repayment day will be on 121st day, right? So 120 days have to be completed for the entire loan. So now let's calculate the date. Since October 1 has to be counted, it means there are 31 days by the evening, by the night of October 31st, right? Uh, 30 days for November. So a total of 61 days at the November end. On December 31st, end of the day, again 31 days for December. So by December 31st, the note actually has been accrued for 92 days, right? So this means that when we will record the interest expense on December 31, it will be, we have to record for 92 days. And we further need 28 more days, right? So 1st January to 28th January, it means 28 more days will make 120. And since the 120 days have been completed on 28th January, it means the repayment will be made on 29th January, right? So 29th January will be the maturity date of the note. So in 120 days calculation, the day of transaction is counted, that is 1st October, but the day of repayment is 121st day. So keep in mind that the repayment day is not 120th day, it's not 28th January, right? Because 28th January has to be calculated for the interest, for the calculation of interest. It means we keep the money with ourselves. Interest is the cost of using money. So 121 days are completed, 120 days are completed on 28th January, midnight, right? And the due date is the 29th January. So for the sake of recalling, you can assume that the transaction takes place early in the morning. So early in the morning of 1st October, we take the loan. It means we keep the money entire day. It means that the interest has to be calculated for the 1st October as well. It is not to be calculated from 2nd October. Similarly, at the end of the January 28, we have just completed 120 days, and we have to calculate the interest for 120 days, and 29 January early morning we will pay the interest. So we will not have to calculate interest for 29 January. So now the adjusting entry for 28th December, we already seen that this has to be calculated for 92 days. So 100,000 into 92 over 360, or we can take 365. In the books usually take 360, but it's more exact to take 365. So academically you can take either of these two. So 12% in the interest rate multiplied by 92 over 360, this is a fraction of year, we keep it 100,000. So this is the amount of interest to be recorded. Interest expense debit, interest payable credit. Then on 29 January, right, when the interest will become, when the note is actually becoming due. So the way to calculate the interest expense, again, there is some expense has to be recorded in January as well. So there are two ways, right? First way is that total interest for 120 days is 100,000 into 120 over 360 into 0.124,000. We have already recorded 3067, so the balance amount has to be recorded as an expense as 933. Or we can calculate it 100,000 multiplied by 28 days of January, because December by the for up to the period of December 31 we have already recorded the interest. So 28 over 360 has to be recorded multiplied by 0.12933. So this is the amount of interest expense which is to be recorded, right? But we will pay not just 933, we will also pay this 3067, and we will also pay this 100,000 face value. So how much we will pay? Notes payable debit, interest payable debit 3067, which we recorded on 31st December, and interest expense debit 933 as we just calculated, and cash credit 104,000. So this completes the accounting for notes payable, and in the other videos we will see some other liabilities.